With us now are Andrew Wallenstein. He is President and Chief Media Analyst at Variety Intelligence Platform, as well as Michael Morris, Senior Managing Director at Guggenheim Securities. Michael, start with you. What's behind this sudden reinterest of investors?
Yeah, it's a great question, Brian. I think there's two things that are really going on right now. One has to do with the fundamentals of the business, and one has to do with just some of the dynamic of ownership and short selling in the marketplace. To the first point, these companies have spent the better part of the last year or two really transitioning their businesses from being linear or traditional business first distribution, our traditional networks that we're used to really putting their streaming foot forward, if you will, making investments in those businesses and making their content available outside of that traditional pay TV bundle. And while that certainly comes with risks that I'm happy to talk about, it also has helped address this concern around terminal values that have been there as we've seen the declines from cord cutting and ratings declines. But at the same time, I don't think you should overlook the fact that these have been heavily shorted names for a very long time. We've seen a dynamic in the marketplace where these shorted names have been squeezed upward. I can't tell you for sure that's what's happening, but we have seen short interest in these names come down. And I do believe that that's part of the dynamic there as well.
Andrew, would you agree with that? Or is there something else at work here that I'm just not seeing?
Oh, I think you're right to question it. I think this is the height of market irrationality. The notion that all of these companies, just because they're investing in streaming, are set up for the future is absolutely ludicrous. It's as if the market has drunk the Disney Plus Kool-Aid and just assumes everyone following that plan is going to do just as well, when I can assure you there's going to be winners, and Disney Plus will be among them, and many of the stocks you just showed on your screen will ultimately prove to be losers. There's only so many streaming services that consumers are going to buy, and a lot of these new players in this market are not coming with the same kind of weight that Netflix and Disney can bring to the table.
Yeah, but Michael, it does, from an analysis perspective, just the balance sheets. I mean, have the balance sheets improved? I'm not picking on anybody, but there's talk about rating struggles on certain news networks now. I mean, it doesn't appear the fundamental business has gotten any better, or has it?
Well, Brian, and I think that this speaks to Andrew's point as well. I think that professional and institutional investors have a lot of skepticism toward the ability of each of these companies to be the winner that is implied by the stock moves that you've seen in these names. I have buy ratings on certain stocks. For example, I agree with Andrew about Disney. We've been big bulls on Netflix. Brian, I've spoken with you plenty of times over the last 5+ years about Netflix and why we like that name. I think that there is no other choice for these companies than to make their product available directly to consumers. And I think that hope can spring eternal when we're in a period where we're only focused on subscriber growth and not necessarily looking at the consolidated economics. But I do agree with Andrew. Mm-hmm. I think once you see the consolidated financial results for the companies, those results have to grow. That's the combination of the new investment in streaming plus that mature linear traditional business. If those in combination are not growing, I think that the recent enthusiasm for the shares does run into some challenges.
Shepard Smith here. Thanks for watching CNBC on YouTube.